Welcome to this Introduction to Accounting Practice module. In this module, we will journey through the essential aspects of accounting, exploring everything from day-to-day bookkeeping and financial reporting to the regulatory changes that shape these practices. Whether you are a seasoned professional or just starting to explore the world of finance, this detailed presentation offers insights into maintaining efficiency, accuracy, and compliance within your accounting operations. Let's begin our exploration by understanding the core role that accounting plays in business. In Australia, accounting is not merely about keeping records. It is a structured and systematic process aimed at capturing every financial transaction with precision. This system is built on a framework of principles that ensure transparency and accountability. At its heart, accounting provides essential information for both internal and external users. For instance, business owners and managers rely on accurate financial statements to make informed decisions, while external parties such as government bodies, creditors, banks, and investors use these reports to evaluate financial performance and viability. Our discussion starts with a look at the key accounting activities that support financial management. The backbone of every effective accounting system includes bookkeeping, financial reporting, tax compliance, payroll management, and budgeting and forecasting. Bookkeeping is the process of recording daily financial transactions, covering everything from sales and purchases to receipts and payments. It is the first step in financial management and ensures that every transaction is documented accurately. Moving on to financial reporting, this activity involves preparing critical documents like the profit and loss statement, balance sheet, and cash flow statement. These reports are essential in presenting a true and fair view of a business's financial performance over a specific period. They not only summarize income and expenses, but also provide a snapshot of the company's financial position at a given point in time. Financial statements are foundational tools for assessing profitability, liquidity, and overall financial health. Tax compliance is equally critical, particularly in a country like Australia, where strict guidelines are enforced by authorities, such as the Australian Taxation Office. Compliance involves calculating, reporting, and remitting taxes accurately, based on the business's earnings and other considerations. Understanding the nuances of tax requirements ensures that businesses avoid legal pitfalls and financial penalties. Equally important is payroll management, which covers the administration of employee wages, superannuation, and other benefits. With changes in the superannuation guarantee rate, which is set to reach 12% by 2025, along with evolving tax and payroll regulations, it is crucial for companies to invest in up-to-date payroll systems that align with current standards. In addition to these core activities, budgeting and forecasting are invaluable practices. They enable businesses to plan for the future and allocate resources effectively. By anticipating financial outcomes, companies can make strategic decisions that drive growth while maintaining compliance with regulatory requirements. These practices together create a robust framework that supports the sustainability and expansion of any business. Now let's shift our focus to some of the key terminologies and concepts that form the foundation of accounting systems. It is essential to understand these terms, as they are the language of finance. For example, revenues represent the total income generated from a business's normal activities, commonly referred to as sales or turnover. It is important to note that not all receipts qualify as revenue. Revenue must be earned from genuine business operations such as the sale of products or services. Expenses, on the other hand, are the costs incurred to earn that revenue. They may be direct cash expenses or non-cash costs that affect a company's overall profitability. Another foundational concept is conventional accounting, which uses traditional methods to record, summarize, and report financial transactions. This approach adheres to well-established principles, such as the generally accepted accounting principles or international standards like the IFRS. The modified historical cost system provides a balance by adjusting certain asset and liability values for market conditions ensuring that the financial statements accurately reflect current economic realities. The accrual basis of accounting further enhances the accuracy of financial records. Under this system, revenues and expenses are recognized when they are earned or incurred, not necessarily when the cash changes hands. This method offers a more precise representation of a company's financial state over time. Additionally, concepts such as the going concern assumption, which presupposes that the business will continue indefinitely, are fundamental in determining the valuation of assets and liabilities. The consistency concept ensures that once an accounting method is adopted, it remains in use over time, allowing for comparability of financial information across different periods. Having established a foundation in the key terms and practices, our discussion now turns to the administration of the financial system. Financial accounts are not simply a set of numbers. They are organized systems that document the flow of business transactions. At the end of a financial period, commonly 1 year, companies prepare comprehensive financial statements. These statements include the profit and loss account, the balance sheet, and the cash flow statement, each serving a unique purpose. The profit and loss statement encapsulates revenues and expenses. The balance sheet outlines assets, liabilities, and equity, and the cash flow statement shows the movement of cash in and out of the business. An important element in the accounting process is the use of source documents. These documents are the foundation of every financial transaction, providing evidence and details that justify the recording of an entry. Source documents such as invoices, receipts, purchase orders, and checks must be accurately maintained. For example, a purchase order signals the business intention to acquire goods, while a sales invoice verifies the sale of products or services. This documentation is then systematically grouped and recorded into their respective journals, ensuring that every transaction is traceable and verifiable. Understanding and managing these source documents cannot be overemphasized. In companies of all sizes, an effective system for processing and filing documents ensures that the business operations run smoothly. Proper design of business documents, along with consistent filing practices, reduces the risk of errors, minimizes administrative costs, and supports legal compliance. As businesses grow, so does the complexity of managing these records, necessitating a well-thought-out document management strategy that might include both physical filing systems and digital solutions. For new businesses, establishing a robust accounting system from the ground up is essential. While startups may deal with less regulation, they still face the challenge of designing documents and systems that meet both operational and regulatory requirements. Inefficient document design can lead to increased costs and delays in data entry, adversely affecting overall business performance. Therefore, implementing standard procedures for document creation, using templates, and adhering to best practices in filing can make a significant difference in ensuring timely and accurate reporting. A significant portion of our discussion centers around the business cycles and how they interact with accounting systems. As a business expands, the direct involvement of the owner in daily operations naturally decreases. In larger organizations, professional teams led by executives, such as the CEO and financial managers, take over the responsibility of maintaining and overseeing accounting systems. These systems consist of various interconnected subsystems that manage specific functions, such as the purchases and payments cycle and the sales and receivables cycle. Let's delve deeper into the purchases and payments cycle. This cycle is fundamental because it deals with how goods and services are purchased, often on credit. When a business purchases goods, it may not always pay up front, thereby creating accounts payable. These accounts represent the money owed to suppliers or creditors. Managing accounts payable involves tracking purchases, ensuring timely payments, and reconciling accounts to avoid discrepancies. For instance, when goods are bought on credit, the amount is initially recorded under accounts payable, and upon payment, the corresponding liability is reduced. If discrepancies occur in the reconciliation process, such as issues with payments or returns, businesses must follow a systematic approach to resolve them, ensuring that supplier accounts reflect the accurate outstanding amounts. In the realm of invoice processing, precision is paramount. Companies must track supplier details and invoice amounts to ensure that payments are made on time and that any early payment discounts are properly utilized. Businesses may even negotiate terms such as 5/10, offering a discount if payment is made within a specified period. Similarly, verifying and reconciling invoices against delivery notes and purchase requisitions is essential to maintain data integrity. In some cases, if discrepancies arise, further investigation and authorization are required to correct the record before proceeding with the payment process. The need for rigorous controls extends to other areas such as check processing. When a check is used, it becomes a key source document, and correct procedures must be in place to prevent fraudulent activities. Verifying check details, including signatures and available funds, ensures that the risk of errors or fraud is minimized. For example, if a check is written on an account with insufficient funds, not only could the check be returned, but further penalties might be incurred by the business. Therefore, financial controls and regular reconciliations are indispensable. Turning our attention now to the sales and receivables cycle, we see another critical component of an effective accounting system. This cycle details how revenues are generated through the sale of goods and services, and how these transactions are managed and recorded. Sales conducted on credit create accounts receivable. For these transactions, it is vital that accurate invoices are issued promptly and that receivables are tracked meticulously. This ensures that the business can manage cash flow, assess customer creditworthiness, and maintain healthy relationships with its clientele. The processes involved in managing sales and receivables include several steps. It starts with validating customer orders, performing credit checks, issuing sequentially numbered invoices, and recording these in the appropriate journals. More importantly, businesses must monitor outstanding amounts and manage overdue payments using techniques such as age trial balance reports. Such reports help in categorizing debts, identifying potential issues, and calculating doubtful debts as necessary. Efficient management of these cycles supports overall financial stability by reducing the risk of uncollected receivables. Banking of receipts is a further critical process in the accounting system. Adequate procedures for handling and depositing cash, checks, and electronic payments are essential to safeguard the company's assets. When cash or negotiable instruments are received, they should be deposited as early as possible, ideally on the same day. This ensures that funds are secure and there is a clear record of the deposit matching each entry in the books. A well-managed banking process not only enhances security, but also supports accurate reconciliation between bank statements and internal records. As we progress further, we encounter the detailed world of debits and credits, a fundamental aspect of how financial transactions are recorded. In accounting, every transaction affects at least two accounts. Debits, which are recorded on the left side of an account, and credits on the right, are used to reflect increases or decreases according to the normal balance of each account. For example, an increase in an asset account is recorded as a debit, while an increase in a liability or revenue account is recorded as a credit. This dual entry system ensures that the accounting equation remains balanced at all times. We also see how different account types respond to debits and credits. Take accounts payable. An increase in liability is recorded as a credit, while a reduction in the payable is recorded as a debit. Conversely, accounts receivable increase on the debit side, reflecting the amount owed to the business by its customers. Understanding these principles is vital to ensure that financial records are accurate and reflect the true state of the business. Alongside these fundamental practices, it is important to discuss the factors that have been affecting accounting practices recently. Government policies and economic conditions play a significant role in shaping how businesses approach financial management. For instance, recent Australian budgets have introduced changes in tax rates and thresholds. Furthermore, adjustments to the tax rates at higher income thresholds and the implementation of policy changes require businesses to adapt their accounting practices to remain compliant. Additionally, adjustments in payroll practices, such as the shift to single-touch payroll (STP) reporting, have driven businesses to invest in compliant payroll systems. Economic conditions, including shifts in pricing, borrowing costs, and market demands, further influence accounting practices. Rising costs of goods and services lead businesses to carefully manage expenses and adjust their budgeting strategies. Additionally, fluctuating interest rates and other market conditions may affect financial forecasting, highlighting the need for dynamic and adaptable financial systems. Reviewing the entire landscape of accounting practices, it becomes evident that a solid accounting system is a critical asset to any business. Whether managing purchases and payments, handling sales and receivables, or ensuring the accurate recording of every financial transaction, the importance of structured, disciplined financial management cannot be overstated. With rigorous documentation, proper filing systems, and an efficient reconciliation process, businesses can protect their assets, maintain compliance with legal standards, and provide a clear, trustworthy picture of their financial health. In summary, we have explored a wide range of topics today, from the vital process of bookkeeping and the preparation of financial reports to the nuanced interpretation of debits and credits. We have also delved into the management cycles for purchases and receivables and underscored the role of source documents in ensuring every transaction is accounted for. Throughout, we have seen that a robust and well-maintained accounting system is indispensable for accurate reporting, operational efficiency, and regulatory compliance. As we conclude this session, consider the role that effective accounting practices play in driving business success. In a constantly evolving regulatory and economic environment, keeping abreast of changes, reviewing internal processes, and adopting best practices is not merely advisable, it is essential. We hope that this overview has deepened your understanding of the complexities and necessities of accounting practices within Australia. The journey to mastering these concepts is ongoing, and continuous learning, adaptation, and attention to detail remain key. Thank you for taking the time to explore this detailed guide on accounting in Australia. We encourage you to review your own accounting practices in light of the insights shared here. As you take these steps forward, you will be better equipped to navigate the challenges of compliance, efficiency, and growth in your business journey. This has been your comprehensive introduction to accounting practices in Australia. We appreciate your attention and look forward to supporting your ongoing journey towards excellence in accounting and financial stewardship.